Most people believe they are in control of their financial life. They believe that if they work hard, pay their bills on time, and avoid obvious mistakes, their future will naturally improve. That belief feels fair, it feels logical, and it's precisely why it works. Because in the United States, your financial trajectory is not shaped primarily by effort or discipline. It is shaped by a system that operates quietly, automatically, and without explanation. A system that reduces your entire financial behavior to a single number, your credit score. It does not warn you, it does not negotiate, but it quietly decides what kind of life you're allowed to build. Most people assume the credit score is fair. They assume it rewards responsible behavior and punishes recklessness. They assume it reflects trustworthiness. But the credit score was never designed to evaluate fairness. It was designed to evaluate risk. It does not measure how disciplined you are. It does not measure how intelligent your decisions were. It does not measure effort, sacrifice, or long-term intent. It measures how closely your past behavior resembles the behavior of people who were profitable to lend to. That distinction matters, because a system optimized for profitability does not care whether your decisions were reasonable. It only cares whether they were predictable. Once your behavior is translated into data, context disappears. A late payment caused by a medical emergency looks identical to one caused by negligence. A temporary job loss looks identical to poor money management. The system does not ask why, it simply recalculates. Credit scores were not created to help individuals improve their financial lives. They were created to solve a scaling problem for lenders. As consumer credit expanded, banks needed a way to evaluate millions of people quickly. Human judgment was slow. Personal interviews were inconsistent. Context was inefficient. So financial institutions built a statistical shortcut. They identified patterns in borrower behavior and converted those patterns into variables: payment history, credit utilization, length of credit history, inquiry frequency. Each variable became a signal. Each signal fed into a probability. Over time, that probability became policy. And once decisions became automated, human understanding was removed from the process. The system no longer needed to understand people, it only needed to rank them. Most people think their credit score only matters when applying for a loan. That belief is outdated. Today, your credit score can influence where you live. Many landlords use it to screen tenants. It can influence how much you pay for insurance. Lower score, higher perceived risk. In some cases, it can even influence employment decisions, particularly in financial or managerial roles. Two individuals can earn the same income, have the same education, live in the same city, yet one pays more for housing, more for transportation, more for basic financial services, not because they earn less, but because the system considers them riskier. The difference is subtle, but over time, it compounds. You are often told that improving your credit score is simply a matter of responsibility. Pay on time, borrow less, be disciplined. But this explanation ignores how the system actually works. Some financially sound decisions can actively harm your credit score. Paying off a loan early can reduce your score. Avoiding credit altogether can reduce your score. Closing old accounts can reduce your score. The system does not reward caution, it rewards participation. A borrower who actively uses credit is easier to model and easier to monetize. Stability in this system does not come from independence, It comes from compliance. This is the core issue. Your credit score is not a reflection of who you are. It is a reflection of how well your behavior fits a financial model designed for lenders. A model that does not adapt to individual circumstances. A model that punishes deviation faster than it rewards recovery. And most people are never taught this. They blame themselves when the system was never built for fairness in the first place. Here is the paradox at the center of the credit system. To prove that you are financially responsible, you must borrow. To maintain a strong credit score, you must continue borrowing. If you stop using credit, your score can decline. If you pay off your debt too efficiently, your score can decline. The system does not reward independence. It rewards activity. You are encouraged to stay inside the system, not exit it. And once something goes wrong, recovery is slow. Missed payments remain on your record for years. Defaults follow you long after the original mistake. Errors take time and effort to correct. The system reacts instantly to negative signals, but it recovers cautiously, often reluctantly. This asymmetry is not accidental. The real impact of a credit score is not felt in a single decision. It is felt over time. A lower score means higher interest rates. Higher interest rates mean higher monthly payments. Higher payments reduce your ability to save. Reduced savings increase reliance on credit. This creates a loop. Over 10 or 20 years, this loop can cost tens of thousands of dollars, not because someone was reckless, but because they entered the system at a disadvantage and never escaped the compounding effects. The system does not trap people with force. It traps them with friction. Every step forward costs more. Every mistake takes longer to erase. This system does not exist to help people become financially free. It exists to help institutions manage risk and maximize profit. Credit card companies benefit from revolving balances. Lenders benefit from long-term interest payments. Financial institutions benefit from predictable borrower behavior. A borrower who pays perfectly and exits the system is not ideal. A borrower who stays active indefinitely, even responsibly, is. That is not a moral judgment. It is a structural reality. The credit system is optimized for stability and profitability, not personal freedom. And once you understand that, many contradictions make sense. No one explains this clearly. No one teaches how credit scores actually function as control mechanisms, not guidance tools. People are told to be responsible, but they are not told how the system interprets responsibility. They are told to avoid mistakes, but they are not told how long mistakes linger. As a result, millions of people internalize failure. They blame themselves. They feel stuck. They assume they are behind because they did something wrong. In many cases, they didn't fail. They simply interacted with the system at the wrong time, in the wrong order, or without the right structure. Your credit score does not ruin your life overnight. It does something more subtle. It limits your options quietly. It determines where you can live, what you can afford, how much risk you are allowed to take. And most people only realize how much control they've lost when they try to change direction. This isn't about fear. It's about clarity. Because once you understand how the system actually works, you stop seeing your situation as a personal failure, and you start recognizing it as a structural constraint. Control does not come from motivation. It comes from understanding the system you are operating inside. And once you understand the system, you can stop reacting to it and start navigating it.